Interactive brokers. Our quarterly earnings reported an $88 million loss. Brought to you by the retail investor accounts, which blew up on the 20th of April. Let me reiterate here, $88 million. Not euros or pounds, but dollars. That is, US dollars, not the Japanese yen or Canadian beaver pelts. How does this happen? What the hell went wrong? Well, here's one big piece of the puzzle. That was oil, for those of you who needed Captain Obvious. And that was a train wreck that just went by. The three main pieces to tonight's big puzzle on mystery theater can be listed as margin issues. After all, it takes an account trading on margin to usually end up in a larger catastrophe than ending with just zero at the end of a disaster. Technical issues. This is what happens when software developers don't ever expect a negative number to get parsed through a series of possible orders. And for those who need Captain Obvious again, the oil crash. We will add many other smaller facets to this list of pieces very soon, but for now, get your popcorn and sodas ready for...
Mystery Theater presents Screw Up on the IBKR Express.
I should apologize, my friends. I did not yet start with a prologue just yet. So, here's the backdrop which began a long time ago in a market far, far away. Press release. Interactive Brokers issues statement on crude oil contracts and margin loss.
Interactive Brokers Group Incorporated, NASDAQ IBKR, today noted that, as has been widely reported, the energy markets yesterday exhibited extraordinary price activity in the New York Mercantile Exchange, NYMEX West Texas Intermediate Crude Oil Contract. The price of the May 2020 contract dropped to an unprecedented negative price of $37.63. This price was the basis for determining the settlement price for cash-settled contracts traded on the CME, Globex, and also on a separate expiring cash-settled futures contract listed on the Intercontinental Exchange Europe, ICE Europe. Several Interactive Brokers customers held long positions in these CME and ICE Europe contracts, and as a result they incurred losses in excess of the equity in their accounts. IBLLC has fulfilled the firm's required variation margin settlements with the respective clearinghouses on behalf of its customers. As a result, the company has recognized an aggregate provisionary loss of approximately $88 million. The company does not believe that any anticipated losses will have a material effect on its financial condition.
Now, personally, that last paragraph really catches my attention. Seriously? Any anticipated losses won't have any material effect? Well, holy Bitcoin, Batman! Who can write off $88 million without having this even affect their balance sheet? Well, Enron may have been an example that I can think of, for a short while anyway. But there is something I do want to share here. Most of the stockholders of IB are held by employees. This is true. Yet for some reason, IB stock fell about 10% overnight when they figured out what had happened. Somehow, I do not feel that shareholders took this past part in total confidence. Before we dig deeper into the details of this mess of rubble, we need to firstly begin with the disaster of oil. This began with the coronavirus itself, due to the fact that people like me have had to stay locked inside and not venture out, causing our oil consumption to rapidly drop down by 30%. Let me reiterate here, we dropped down by 30% in consumption. Not production or suction, but a 30% reduction in consumption. Due to various rules of economics and the universe, such as supply and demand, as well as Murphy's Law, this means we were stuck with a big surplus of oil. Again, supply versus demand. Capiche? Naturally, cheaper oil right now is great for when you want to fill your car at a great discount, and this is where Murphy's Law comes into play. I'm not working right now. We're staying at home all nice and tight. Vehicles aren't moving much, planes are not flying, and pigs aren't flying either. So, of course, this is going to be the time that prices for fuel are going to drop. Just to spite me, of course. There is no stopping Murphy's Law, except when you purposely try to trade options betting against Murphy. That's when Murphy's Law finally fails. There is no getting around Murphy, my friend investors. The best you can do is hedge your bets. As much as we would still like to think that cheap oil prices are good for the economy, the opposite tends to happen, historically speaking. Furthermore, in North America, it is much more expensive for the United States and Canada to produce oil than, say, the Middle East or even Russia for that matter. Oil generally needs to be around a particular price, or those two nations will be out of a job, literally and permanently. With oil being so low, it is no surprise that many of the oil companies in these two countries are having great difficulty, and the price of oil must go higher. If not, we will have a string of many more energy companies going broke. With the filing of bankruptcy by Whiting Petroleum being only the very start in a whole string, well, I should not have to remind anyone that this is a very real possibility here. For far too long, we've had energy companies building massive debt and over-leveraging and too much competition between them. This also has become compounded by the recent boom of fracking Ponzi schemes. Well, things have gone from bad to worse to terrible now. You see, the Russians and Saudis have started an oil war with each other after a breakdown of OPEC talks. Here again is where Murphy's Law has hit us again. Of all the timing in the world, right now, during this pandemic, is when we got hit by an oil war.
Duh. What is OPEC?
The OPEC. OPEC is the Organization of the Petroleum Exporting Countries. It's a fancy schmancy title that basically refers to an organization of 13 nations which have been gathering around since the 1960s and discuss oil pricing issues. However, we now have something called the OPEC Plus ever since 2016. This includes 10 more countries added to the original group, one of these being Russia. And this is where a lot of drama began. Supposedly, during an OPEC meeting, Russia got into a little bit of a heated dispute with the Saudis. Now, we don't exactly know in details what supposedly happened, but it went something along like this.
I'm not gonna go listen to you. I'm gonna go do what I want.
Oh, yeah? Well, I'm not going to listen to you either then.
Well, fine then. I'm gonna go to sell at lower prices than you. How's them apples?
Oh, no, you don't. I'm going to sell cheaper than you. How's them apples?
Well, fine then. Go do it. Go try then.
Well, yeah, man. I am, man.
So go do so.
I am, man.
And so, the start of the oil war has begun. And yes, I said oil here, as they were supposedly arguing about the price of oil and outcompeting each other in the marketplace. Now notice, I did say supposedly a few times in this story. And that's because I can't find anyone who really knows for sure the exact details on what has happened. But just about every hedge fund in the world right now and the rest of the smart money knows clear well that this just seems a little too suspicious to have occurred right at this time in history. Honestly, right when the United States and Canada were getting hit by this pandemic, is right when the Saudis and Russia decided to pour more salt into their wounds by starting this price war. Either way, regardless of what you want to believe, if this is just a freaky coincidence or a deliberate smokescreen, let us look at the facts here and why this is crippling North America. It is much more expensive for North America to produce oil. For this reason, oil needs to be set at a particular minimum value for these companies to be profitable. It is also much cheaper for the Saudis and Russia to produce oil than in the West. The Americans have a lot of fracking for production, while the Canadians have this and the oil sands, otherwise known as tar sands. These are now losing so much money a day that it is not worth it for the companies to be even running, as nothing is profitable here. One interesting note here is that the Saudis and Russians are actually losing money themselves, but as production is cheaper for them, the damage on their end is much less than here. What is truly interesting though, as companies in the West are declaring bankruptcy, all this plays into the hands of the Russians and the Saudis. The more the pain is delivered in the West, the more bankruptcies will occur, and in the end of this price war, the two warring nations will still come out ahead as big players in a less competitive market. Well, with all this massive production going on at super cheap prices, things finally got to the point of oil being drastically so cheap that it was free. Oh, wait a minute, not free, but you were paid to take it for free. If that makes any sense. And if it does not make any sense, no worries, my friends, because this has never, ever happened in history before. For the next chapter of this story, we need to examine futures contracts. While stocks of companies can be traded simply enough on stock market exchanges, after all, you're just buying up equity of a company, the purchase of something like oil works differently. Oil in itself is not a company. It is what we refer to as a commodity. There are many different types of commodities traded on exchanges. These can include precious metals as well as toilet paper. What makes trading commodity future contracts more complex than simple equities is an investor does not just buy up some stock, then let it sit there until his old age, then cashes out during retirement. These commodity contracts are based on contracts going out into the future and are constantly rolled. What happened this April was that the contract for oil set for the month of May took a tremendous drop in price. After all, between the oil war going on and the fact that no one is using oil right now, there was far too much supply and hence the demand went down. This went down so much that we saw people literally trying to give it away. This was opposite the case of the toilet paper commodity, where the price had shot up sky high and people were killing and robbing each other for it. Alright, for those who need Captain Obvious, toilet paper is not a commodity, nor is it exchanged on exchanges. But I think we've made our point clear. To dig a little deeper on how the oil dropped so much for the May contracts and prevent any confusion to the retail investor watching this, I will discuss two separate oil contracts. There are about a dozen different benchmarks when it comes to crude oil. However, two of the most common are Brent and WTI. The WTI is an acronym for West Texas Intermediate. Now, let's do some comparison. For Brent, we are dealing with oil from the North Sea. Because of this, it is waterborne, and this makes shipping much easier and cheaper. As for WTI, it is landlocked, and the oil ends up being shipped around in pipes and whatnot. This adds to the expense of the oil, and most of it is derived from Texas. One key name that everyone is familiar with is Cushing, Oklahoma. This is a center point which deals with the delivery of the oil. We'll discuss this part again soon in detail, my friend. Brent is also known for being more heavy than WTI. The reason for this is that it has a slightly heavier sulfur concentration. It is also because of this that we deem it to be more sour than WTI, and WTI is considered more sweet. In fact, an old school method of testing grades was to physically use your tongue and do the taste test. Well, I wouldn't subscribe to doing it personally, but, well, I'm sure it's not as bad as doing the test on antifreeze, for example. Oh, there is one more thing. Brent seems to be the most popular benchmark by far, meaning 2/3 of the world's population uses it, while WTI mostly revolves around America. Oh, and one more thing, point oh. With WTI, delivery is required. Unlike Brent, which does not involve transportation regarding the commodity, WTI requires the person holding the contracts at the end of expiration to also be prepared for delivery. Now, what happens when you, the retail investor, hedger, self-proclaimed expert of a speculator who was planning to sell the contracts near the end of expiration, failed to do so unintentionally? Oh boy. Well, you are most likely going to get a phone call from somebody, probably your broker to start off with, and this broker is most likely going to remind you of the very fact that your contracts are legally binding, and each one of them counts for 1,000 barrels apiece. You really are on the hook for delivery here. However, there is one method that may save you if you are lucky. The broker will try to find someone else who was on the opposite side of the trade, who was just as smart as you and screwed up on their end. If you are matched, congratulations, you have just got your saved. And learn not to trade commodity futures again until you subscribe to this channel for your future education, of course. Now, if there is no match carried out, you, my friend, are in some serious trouble and desperately trying to get off that hook. Not only that, but this situation can get worse if you have leveraged. Now, most commodity traders, as well as idiots like myself who tend to stick with mostly securities, enjoy the benefits of margin too. Who doesn't like to have credit given to them, especially when you can buy even more of something that you can not really afford, and bonus points if it's risky at that. In fact, Warren Buffett has mentioned before that liquor and leverage have been the two main reasons he's seen people get destroyed, leverage being the primary reason. So let that sink in. You can end up far, far worse on the hook than you can imagine. Now, on Monday, April the 20th, or otherwise known as Black Monday 2.0, we had the last day of trading for the upcoming May futures contract of WTI. What made this day so devastating was the price of oil was already depressed. But as trading continued, it became apparent that there was a massive liquidity issue. The problem was that there were too many sellers trying to offload these contracts, while there were not enough buyers about, due to the fact that there was just no room left to store oil. The hub down in Cushing, Oklahoma simply had no more storage. So what do you think happens in a spot like this? A whole ton of traders got squeezed and tried to make a run for the exit. You see, who in their right mind wanted to get stuck on the hook? This is where everything finally came together and the mini bubble burst. What had earlier been chased after for a planned profit were now suddenly toxic items that everyone was in a mad rush to offload onto someone else. Kind of reminds you of those mortgage-backed securities back in 2008, now doesn't it? But the story gets even more twisted. There were some speculators in commodities who saw the prices falling and came running on the exchanges in an attempt to purchase whatever they could. Some of these speculators had no understanding of what toxic items they were purchasing and even tried to double down on them as they approached zero. Oh, did I say zero? Well, to make a bargain better, the prices dropped down to negative territory, closing for the day at a negative of $37.63. And some of these people had no idea of what kind of trouble they were in. Interactive brokers themselves also did not realize how much trouble they were in. Even 24 hours later, they still did not have the full picture, but they did piece together the gist of it. And ironically, there happened to be a quarterly conference call scheduled on the 21st Thomas Petterfy, the CEO of IBKR, which we all love so much, also addressed the public on CBNC before handling the earnings call later that evening.
Let's talk about your retail clients that were long energy, whether they own futures or ETFs. How much pain is there out there given these extraordinary moves we've seen in the price of oil?
So unfortunately, as we announced just about half an hour ago, last night, several of our retail clients have suffered very large losses because they were long certain cash-settled futures whose price is derived from the deliverable WTI future. And so suddenly negative prices going to minus 37 within very few minutes. They were unable to do anything about that, and the settlement price turned out to be negative $37 a barrel. So this is a very new experience for us and our customers, and it's very unfortunate. And we'll just have to cope with it somehow.
Thomas, I'm looking through your statement that addresses that in particular. And I believe what it's saying is that some customers were taken into negative territory for their accounts, which is not typical, of course, for retail clients who don't often have margin positions or lending. So who's on the hook for that? If these contracts, which they didn't fully understand, put them into negative, do you have to cough up the losses?
Absolutely. So being a broker is not always very good because, when something good happens, it's the customer gets the benefit. If something bad happens, it's usually the broker who has to cough up the money.
Now, for those of you who were listening to that and not browsing Pornhub just now, you will distinctly remember Thomas mentioning cash settled. This is different from physically settled. Now, way back from the start of this documentary, I had mentioned that WTI futures was physically settled. However, there is a caveat here, and I did not wish to overconfuse anyone earlier. There are also some WTI futures that are set up as cash settled. And it is this particular variant where clients using Interactive Brokers got stuck holding long positions on these contracts. Now, what may seem a little odd to new people to this story is that no one got caught on the WTI physically settled contracts. But this should not be any surprise to those who know IB in detail, as they had a fail-safe put in place specifically for this. The futures closeout policy basically gives IB the rights to do what it takes necessary to prevent clients from getting on the hook for deliveries of expiring futures contracts. It can force clients to roll forward or to close out positions prior to the start of the closeout deadline specific to the contract. IB gives itself the right to even liquidate without any prior notification. IB also has other strings to pull, such as only allowing margin-reducing transactions with only 5 days prior to expiration, etc. What happened here was not an issue with WTI contracts for physically delivery on the NYMEX exchange. What happened was clients who avoided the NYMEX and instead purchased crude oil cash-settled contracts through the CME and ICE Europe exchanges. This is what caused Interactive Brokers so much headache. If this is just a little bit confusing to some of you still, don't worry. Even the self-declared gurus, beginning commodity apprentices, and
I'm a student learning to become a day trader so I can buy my Lambo.
Got their jiffies in a bunch arguing over this. I could post a few hundred messages from forums like Reddit to Elite Trader, but I'll just sum one up here, which no doubt is still being torn apart at this very moment. LOL at dip shits. Symbol CL WTI NYMEX is physically settled. Symbol WTI IPE/ICE is cash settled. So latter can trade until expiry last minute if no possibility of delivery. Quoting in response to Red Duke said, "You are a f-king liar and a troll. IB prevented any orders on Monday for May contract. If you traded live, you would know it. Go and hide under the rock where you crawled from. Quote in response to Help Me Please said, in fact, I'm shocked that IB even lets you take the trade in the first place, since the May oil contract is so near to expiry and IB clients have no means to take physical delivery. Alright, I'm not going to attempt to correct or overcorrect and further add to banter here. I will simply end with a final word for validation. I have recorded a clip from Interactive's quarterly earnings call when the CEO addressed the following question.
I guess my question has to do with the press release that you put out after the close about the provisionary loss you're going to take related to the WTI contracts. And I guess the question is, was this due to customers holding the positions right till close to expiration? Because I'm just wondering how they could ever fulfill like the physical delivery requirement of holding the contract.
So, Rich, first of all, I would like to apologize for springing this announcement onto everybody so unexpectedly. This happened to us just last night. We were up most of the night trying to figure out what was going on, and we still do not have all of our facts completely in order, but I felt that we have to put out this notice. Now, as to your question, this was a cash-delivered contract, cash-settled contract. So it was not about delivering. The cash-settled contract is priced off of the delivered contract, the CL. So this is WTI that is priced off of the CL, and the CL settlement price, which is a delivered contract, determines the settlement price, the CL trade price in a 2-minute window at between 2:28 and 2:30 New York time. Determine the volume weighted average price in those 2 minutes on the CL contract determines the settlement price for this cash settlement contract. So most of the loss came from WTI, and some of it came from, Paul, you remember the name of that future?
QM, which is the mini
QM.
crude oil contract.
The mini crude oil contract that's trading on the CME.
Okay, so both the contracts are listed contracts on the CME then. Is that correct?
No. The WTI is listed on ICE Europe.
Got it. Okay.
So ICE has a European branch, and that's where it is listed. And the bulk of the position was on that contract.
The one thing that was not mentioned in any of the recordings by the CEO of Interactive Brokers was that of technical issues with the negative numbers. It did not take long for a few complaints to surface regarding not only the failed ability of IB to display negative numbers when the WTI had crossed the zero marker, but the platform seemed to also refuse to accept sell orders at that point. Users trying to execute a limit order found the system wouldn't work. Try to sell on a market order instead? Nope, those failed to execute as well. It also appears that IB's liquidation failsafes also refused to execute as designed, tripped over by the negative prices. What is truly mind-boggling even more so is that IB supposedly had been warned at least 5 days in advance that negative crude oil prices could be a remote possibility. And yet, no design change to handle this had been executed. With that said, All these issues led up to an $88 million loss for the broker. But that isn't even the whole story. There were many more losses than just this out there by other people outside of Interactive, as the CEO grimly mentioned.
Well, we carried about 15% of the open interest in these contracts. So our customers have lost about $88 million. So there is another $500 million to of losses that somebody is sitting on, or other folks are sitting on. And of course, there are offsetting $600 million of gains. And I do not know who those folks are.